When money needs walls to stay home, the system is already broken. On March 16, 2013, Cyprus woke up to find that their banks had been transformed overnight, not through military occupation or natural disaster, but through something far more sinister. Electronic barriers, digital walls, capital controls that prevented citizens from accessing their own money, ATMs were shut down, wire transfers were blocked, international payments were frozen. The government had built invisible walls around every bank in the country, trapping money inside while claiming it was for everyone's protection. Cyprus wasn't experiencing a banking crisis. It was experiencing the final stage of monetary system breakdown when authorities abandoned the fundamental principle that makes money valuable, the ability to move it freely. When governments start building walls around banks, they're admitting that their monetary system has entered terminal failure mode. The walls aren't protecting the money. They're hiding the fact that the money has already lost its essential characteristic, liquidity. This pattern isn't unique to Cyprus. It's universal. Throughout history, every monetary system collapse has followed the same sequence. First, authorities promise that money can move freely across borders and between institutions. Then, they implement temporary restrictions to manage specific problems. Finally, they build permanent walls that trap money while the system dies behind barriers designed to prevent citizens from witnessing the death. Today, wealthy nations across the globe are constructing increasingly sophisticated walls around their banking systems, not through dramatic announcements or emergency declarations, but through administrative measures, regulatory adjustments, and technological innovations that gradually restrict capital movement while maintaining the illusion of monetary freedom. The walls are being built systematically, quietly, and irreversibly. The Cyprus experiment revealed the modern template for monetary system control during collapse. Unlike historical capital controls that used physical barriers and administrative procedures, digital banking allows governments to implement instantaneous, comprehensive restrictions that can be activated without warning and modified in real time. Every electronic transaction can be monitored, restricted, or blocked based on algorithmic criteria that citizens never see. But Cyprus also revealed why modern capital controls fail more completely than historical versions. In 1930s Germany or 1970s Argentina, capital controls could be enforced through physical barriers and administrative oversight. Citizens could circumvent restrictions through cash transactions, barter systems, or informal networks. Modern digital banking makes restrictions more comprehensive, but also makes system failure more visible and immediate. When Cyprus froze electronic banking, citizens immediately understood that their currency had lost essential properties that define money. Cypriots couldn't pay bills, transfer funds, or conduct business. The restrictions intended to preserve confidence instead demonstrated that their monetary system had already failed. The walls built to protect the banks revealed that the banks were already insolvent. The speed of Cyprus's monetary collapse demonstrated how quickly confidence can evaporate once capital controls are implemented. Cyprus had been considered a stable, prosperous European nation with sound banking institutions. Within hours of implementing capital controls, Cyprus became a cautionary example of monetary system failure that European leaders promised could never happen to Eurozone members. But Cyprus was just the prototype, the testing ground for capital control mechanisms that have since been refined, standardized, and prepared for implementation across other jurisdictions. The lessons learned in Cyprus weren't about preventing future crises. They were about managing monetary system collapse more efficiently when other currencies face similar pressures. China provides the clearest example of systematic wall building around banking systems. Since 2015, Chinese authorities have implemented increasingly sophisticated capital controls that restrict money movement while maintaining the appearance of normal banking operations. The restrictions began as temporary measures to manage currency volatility during stock market turbulence. They've evolved into permanent infrastructure for monetary system control. Chinese capital controls operate through multiple layers of restriction that create the impression of choice while eliminating actual options. Citizens can theoretically transfer money internationally, but approval processes are complex, time-consuming, and unpredictable. Businesses can engage in foreign transactions, but documentation requirements are extensive and regulatory interpretation changes frequently. Banks can process international payments, but compliance costs and regulatory risks make many transactions economically unfeasible. The sophistication of Chinese capital controls lies in their invisibility. Unlike Cyprus's dramatic overnight restrictions, Chinese controls operate through bureaucratic friction that gradually increases until capital movement becomes practically impossible while remaining theoretically legal. Citizens don't face explicit prohibitions. They face administrative obstacles that achieve identical results without generating obvious resistance. Chinese authorities justify these controls as prudential measures to prevent speculative capital flows and maintain financial stability. The narrative emphasizes protection of domestic savers and businesses from international financial volatility. But the mathematical reality reveals different motivations. Chinese capital controls prevent currency depreciation that would occur if citizens could freely convert yuan into foreign assets. The Chinese yuan's value depends on regulatory restrictions that prevent natural market forces from operating. Without capital controls, Chinese citizens would likely reduce yuan holdings in favor of currencies with greater stability and freedom. The controls maintain artificial demand for yuan by eliminating alternatives rather than making yuan genuinely attractive relative to competing currencies. This creates feedback loops that require increasingly restrictive controls. Each new restriction validates citizens' suspicions that yuan liquidity is problematic. Each validation increases desire to diversify into foreign assets. Each increase in diversification pressure requires additional controls to maintain yuan stability. The wall-building process becomes self-reinforcing and irreversible. European Union authorities watched the Chinese model with interest rather than concern. EU leadership recognized that capital controls could provide tools for managing monetary system stress without admitting fundamental problems. The Cyprus experiment demonstrated feasibility. The Chinese model demonstrated sustainability. Combined, they provided a template for managing currency crises through administrative control rather than market mechanisms. European central bank policies since 2015 have gradually created infrastructure for comprehensive capital controls without implementing explicit restrictions. Negative interest rates force savers to pay banks for holding deposits, creating artificial incentives to maintain domestic currency holdings. Banking regulations require extensive documentation for international transfers, increasing friction for capital movement. Digital currency initiatives create technological infrastructure for transaction monitoring and control. These policies operate below the threshold of obvious capital controls while achieving similar results. European savers face practical obstacles to international diversification. European businesses encounter regulatory friction for foreign investment. European banks experience compliance costs that discourage international transactions. The walls are being built through regulatory accumulation rather than dramatic implementation. The justification remains consistent across jurisdictions. Capital controls protect domestic financial stability. They prevent speculative attacks on currencies. They maintain monetary policy effectiveness. They preserve national economic sovereignty. But historical analysis reveals these justifications as post hoc rationalizations for policies driven by mathematical necessities rather than policy preferences. When monetary authorities implement capital controls, They're responding to mathematical pressure that makes unrestricted capital movement incompatible with currency stability. Citizens with free capital movement would rationally diversify away from currencies experiencing debasement, fiscal stress, or political instability. Capital controls prevent this rational response by eliminating choice rather than eliminating underlying problems. United States policy development follows similar patterns with greater sophistication and subtlety. American authorities haven't implemented obvious capital controls because dollar reserve currency status provides temporary protection from capital flight pressures. But infrastructure for comprehensive capital controls has been developed and tested through various emergency authorities and regulatory frameworks. The Foreign Account Tax Compliance Act requires global financial institutions to report American citizen accounts to U.S. authorities. This creates comprehensive monitoring infrastructure that can be converted into control infrastructure without additional legislation. Know Your Customer regulations require banks to collect detailed information about account holders and transaction purposes. Anti-money laundering requirements mandate reporting of transactions that meet algorithmic criteria. Combined, these regulatory frameworks create comprehensive surveillance of capital movements that can be converted into comprehensive control of capital movements through administrative action rather than legislative process. The infrastructure exists to implement Cyprus-style capital controls across the U.S. financial system within hours, if authorities determine such measures are necessary. The sophistication of American capital control preparation lies in its integration with legitimate regulatory objectives. Citizens accept surveillance and reporting requirements as necessary for tax compliance and anti-terrorism efforts. Banks implement monitoring and control systems as normal business operations. The infrastructure for monetary system control develops without resistance because it appears designed for other purposes. But mathematical pressure is building within the American monetary system that may eventually require activation of this control infrastructure. Federal debt levels exceed historical sustainability thresholds. Currency creation rates approach hyperinflationary territory. Trade deficits require foreign financing that depends on continued confidence in dollar stability. If confidence breaks, capital flight pressure could necessitate immediate implementation of comprehensive controls. The pattern is consistent across jurisdictions and time periods. Monetary authorities build capital control infrastructure during periods of apparent stability. They justify construction as prudential preparation for hypothetical emergencies. They activate controls when mathematical pressure exceeds political tolerance for market-determined currency values. They maintain controls indefinitely because underlying problems typically worsen rather than resolve. Argentina provides the most comprehensive demonstration of this pattern across multiple currency crises. Argentine authorities have implemented capital controls during every major monetary crisis since the 1970s. Each implementation follows identical justifications: protecting domestic savers, preventing speculative attacks, maintaining monetary sovereignty. Each control regime fails to resolve underlying fiscal and monetary imbalances while making the next crisis more severe. Argentine capital controls during the 2001 crisis transformed bank deposits into government debt without depositor consent. Citizens who thought they owned dollars discovered they owned pesos after mandatory conversion at artificial exchange rates. The controls prevented capital flight by confiscating capital rather than making domestic currency attractive relative to alternatives. Argentine capital controls during the 2019 crisis demonstrated how quickly modern digital banking can implement comprehensive restrictions. Citizens faced immediate limits on dollar purchases, international transfers, and foreign currency holdings. The controls were activated without legislative process or judicial review. Banks simply modified their computer systems to block transactions that previously operated normally. The speed and comprehensiveness of Argentine digital controls revealed the efficiency of modern capital control mechanisms. Unlike historical restrictions that required physical enforcement and administrative oversight, digital controls operate automatically through banking software that can be modified instantly. Citizens have no mechanism for circumventing algorithmic restrictions that operate at the transaction level. But Argentine controls also revealed the economic consequences of trapping money behind walls. Each control regime accelerated inflation, reduced economic growth, and increased political instability. The walls built to protect the monetary system instead isolated the economy from international capital and commerce. Argentina became progressively less integrated with global markets as capital controls made international transactions increasingly difficult. Turkey's capital control evolution demonstrates how authorities gradually build walls through incremental policy changes that cumulatively achieve comprehensive restrictions. Turkish authorities began with modest documentation requirements for international transfers. They progressed to transaction limits and approval processes. They culminated in comprehensive controls that effectively eliminated free capital movement while maintaining the appearance of legal currency exchange. Turkish capital controls operate through exchange rate manipulation that makes international transactions economically unfeasible rather than legally prohibited. Official exchange rates differ substantially from market rates, creating artificial costs for international currency conversion. Citizens can legally exchange Turkish lira for foreign currency, but exchange rates make such transactions economically irrational. This demonstrates the sophistication of modern capital control techniques. Rather than explicit prohibitions that generate political resistance, authorities create economic incentives that achieve identical results while preserving the illusion of choice. Citizens remain legally free to move capital internationally while facing practical obstacles that make such movement effectively impossible. The psychological impact of capital controls extends beyond their immediate economic effects. When governments build walls around banks, they signal fundamental lack of confidence in their own monetary systems. Citizens recognize that authorities who trusted their currency wouldn't need to prevent people from exchanging it freely. Capital controls reveal government admission of monetary system weakness. This psychological dynamic accelerates the problems that capital controls attempt to solve. Citizens who might have maintained domestic currency holdings under normal circumstances become eager to diversify when restrictions demonstrate official concern about currency stability. Each new restriction validates citizen suspicions and increases pressure for additional restrictions. The mathematical progression becomes irreversible because capital controls address symptoms rather than causes of monetary system stress. Currency debasement, fiscal imbalances, and political instability typically continue or worsen after control implementation. Citizens recognize that walls are being built to hide problems rather than solve them. Confidence deteriorates further, requiring additional controls to maintain artificial currency stability. Modern technology accelerates this progression by making capital control effects immediately visible and universally communicable. When Cyprus froze banking systems, global audiences witnessed the impact through social media and international news coverage. When China implemented yuan restrictions, international businesses immediately adjusted their operations to accommodate regulatory barriers. When Argentina activated peso controls, global investors immediately reduced exposure to Argentine assets. The transparency of modern capital controls eliminates the time lag that previously allowed authorities to manage currency crises gradually. Citizens, businesses, and investors can observe control implementation in real time and adjust their behavior immediately. This accelerates capital flight pressure and requires more comprehensive controls to achieve intended effects. Central bank digital currencies represent the ultimate evolution of capital control infrastructure. CBDCs provide authorities with comprehensive transaction monitoring and control capabilities that exceed anything possible with conventional banking systems. Every transaction can be tracked, analyzed, and potentially restricted based on algorithmic criteria that operate without human oversight. CBDC systems can implement instantaneous, comprehensive capital controls through software modifications that require no legislative process or administrative action. Citizens using CBDCs would have no mechanism for circumventing restrictions programmed into the currency itself. The walls around banks become walls around money itself. But CBDC development also reveals the desperation behind modern capital control construction. Authorities are building increasingly sophisticated restriction mechanisms because they recognize that existing monetary systems face mathematical pressures that cannot be resolved through conventional policy tools. The walls are being built because the systems they're designed to protect are approaching failure. The global coordination of capital control development suggests recognition of systemic rather than local monetary problems. Individual nations implementing capital controls could reflect specific domestic issues. Coordinated development across multiple jurisdictions suggests preparation for global monetary system stress that will affect all participants simultaneously. International organizations have begun providing technical assistance for capital control implementation rather than discouraging such measures. The International Monetary Fund, which previously opposed capital controls as economically inefficient, now provides guidance for their implementation as crisis management tools. The Bank for International Settlements coordinates central bank research into digital currency control mechanisms. This institutional support indicates that capital controls have become accepted tools for monetary system management rather than emergency measures for crisis response. The walls are being built as permanent infrastructure rather than temporary barriers. Authorities across multiple jurisdictions are preparing for monetary conditions that will require ongoing capital restrictions rather than temporary controls. The mathematical inevitability of capital controls during monetary system stress means that current wall building represents preparation for problems that have already become unavoidable. When currency creation exceeds productive capacity by sufficient margins for sufficient duration, capital flight becomes rational response to currency debasement. Capital controls become necessary to prevent rational responses from accelerating currency collapse. Understanding capital controls as symptoms of monetary system failure rather than causes of economic problems provides insight into why wall building around banks has become a global phenomenon. Authorities aren't implementing controls to solve monetary problems. They're implementing controls to manage the political consequences of monetary problems that cannot be solved through conventional policy tools. The walls are being built because the monetary systems they're designed to protect have already entered terminal phases where market-determined values would reveal the extent of underlying problems. Capital controls maintain artificial currency values by preventing natural market forces from operating. They preserve political stability by hiding mathematical reality behind regulatory barriers. But walls that prevent money from moving freely also prevent monetary systems from functioning effectively. Capital controls reduce economic efficiency, limit growth opportunities, and isolate domestic economies from international markets. The protection provided by capital controls comes at costs that typically exceed the benefits of maintaining artificial currency stability. Historical analysis demonstrates that capital controls delay rather than prevent monetary system collapse. Every major currency crisis that involved capital control implementation eventually resulted in currency devaluation, economic contraction, or monetary system replacement. The walls built to protect monetary systems became barriers that prevented adaptation to changing economic conditions. The current global construction of capital control infrastructure suggests that authorities expect monetary conditions that will require ongoing restrictions on capital movement. The walls are being built because those who understand monetary system mathematics recognize that free capital movement has become incompatible with currency stability across multiple jurisdictions simultaneously. When wealthy nations start building walls around their banks, they're preparing for monetary system breakdown that they cannot prevent but hope to manage. The walls won't protect the money. They'll hide the fact that the money has already lost the essential characteristics that made it valuable. The barriers being constructed around banking systems today are tombstones for monetary systems that are already dead but have not yet been buried. The construction continues because the alternative, allowing market forces to reveal the true condition of existing monetary systems, would create immediate political and economic chaos that authorities consider unacceptable. The walls provide time to prepare for post-collapse monetary arrangements while maintaining the illusion that current systems remain functional. When money needs walls to stay home, the system is already broken. The walls being built around banks today are admission that the monetary systems they're designed to protect have entered failure modes where natural market operations would reveal problems that authorities cannot solve through conventional policy tools. The barriers represent preparation for collapse rather than prevention of collapse. The pattern is universal, the mathematics are inexorable, and the outcome is predetermined by forces that cannot be controlled through regulatory construction. When wealthy nations start building walls around their banks, they're acknowledging that their monetary systems have become incompatible with the free movement of capital that defines functional money. The walls are confession that the system is already broken beyond repair.